everyone. Welcome to Wealth Redefined. I'm your host, Michael Reynolds, independent financial advisor and owner of Elevation Financial. Thanks for joining me today. Glad you are here. Welcome, welcome. Hey, how about that GameStop? That's what we're going to talk about today. So this is a episode all around the craziness, the hype, the stuff that is happening in the stock market, most recently attributed to the the GameStop issue. And already right off the bat, Leslie is here to heckle me on Facebook Live with stonks. So thank you, Leslie. I appreciate that you are here. Thank you. Thank you. So let's talk stock market. Let's talk GameStop. Let's talk all the things. So should I play around in the stock market? That's the question I'm going to discuss today. And it's been asked more than once by, some clients, just some people in general, both in a joking and in a serious way. It's a real question, but obviously a lot of hype and humor is circulating around the GameStop stuff that's happened recently. So if you're not familiar with what's happened with GameStop, just Google it, look up, what happened with GameStop, and you'll find a bunch of stuff. I'm not going to go into like exactly what happened, but we are going to kind of cover the feeling and the kind of questions surrounding, should I get into the stock market? Should I play around? Should I trade? Like, what am I missing out on something that other people are, benefiting from? So we're going to talk about that today. So the question kind of frame here for reference is, should I play around in the stock market? Or a variation might be, should I get into the stock market? Should I trade in the stock market? Should I play with the stock market? Should I experiment with the stock market? So what's happening here is that stock market events tend to lead to increased interest. This kind of stuff happens all the time. I shouldn't say all the time, but it happens a lot. So, for example, most recently in 2020, the volatility that we saw in 2020 as a result of COVID, we saw a lot of sudden interest in playing in the stock market from a lot of people who saw the volatility in 2020 and said, oh, wow, the stock market is suddenly in the news. People are talking about it more. It's bumping up and down. People are saying all sorts of opinions left and right. And I feel like I'm missing out on something. I feel like there's something going on that I'm not participating in. Same thing recently in January 2021, when GameStop shot up in a ridiculous fashion, and tons of people made and lost money in this weird turn of events. So that has also led to a ton of increased interest in the stock market. Whenever something out of the ordinary happens, people tend to take interest because the media, people in the news are shouting at them. People are talking about it. It's all over Facebook. It's just this thing. So, for example, Robinhood, the trading app, had over 3 million downloads in January of 2021, which is the highest on record, the highest month they've had on record. Tons of people said, okay, wow, something's happening. I want to get in on this. I want to trade stocks. I want to make money too. They grabbed Robinhood, they downloaded the app, they set up accounts. People are starting to kind of get interested in the stock market when stuff like this happens. It's called FOMO, fear of missing out. FOMO is just this tendency of seeing, well, there's stuff happening around me. I feel like people are out there benefiting from something. I feel like people are in on something I'm not in on. I feel like people are making money with the stock market. I don't know how or why, but I'm not. And so FOMO kind of takes over. The fear of missing out kicks in, and it's human nature for us to develop an interest and to feel like, oh, I'm missing out on something and I want to get in on this. So that's kind of what tends to happen. When the stock market's boring and just kind of doing its gradual little uptake here and there and not much movement, people don't really pay as much attention. But when there's huge swings, when there's, huge stories like this happening, then we get interested. So back to the question, should I play around in the stock market? Let's define what that means. I'm using the word kind of play around because that's used by a lot of people. Should I play in the stock market? Should I, play around? Should I play the market? That's kind of the term a lot of people use. So let's kind of define what that means first. So when some people say, should I play around in the stock market? They mean day trading. They mean trying to grab stocks and, sell them when they're up and, buy them when they're down and kind of ride those waves up and down in those margins and make money throughout the course of a day by trading stocks rapidly. That's day trading. At the other end, there's people that say, well, should I buy and hold stocks? Should I buy some stocks, hold them for a while, maybe companies I believe in? Should I invest in single stocks when it's more of a long-term decision, when I'm buying a stock and kind of holding it? And there's in between. Some people are doing both. Some people are saying, well, I want to get some stocks, hold them for a little while, and then I might sell them. I'm going to kind of try to time the market. It may not be a day trading situation, but I'm still going to try to time the market. I'm going to buy low, and then a few months later, I might try to see if it goes up, and then maybe sell it, and then buy some more. So there's a spectrum. At one end, there's hyperactive day trading. At the other end, there's buying and holding a stock for a long time, and there's kind of in the middle. So this spectrum, I'm kind of calling playing in the market, from very active to much more passive. So wherever you're feeling on that spectrum, or whatever you define, playing in the stock market is, like, that's kind of where that spectrum is. So I'm going to share some statistics on day trading specifically first. I'm going to talk about that a little bit. And by the way, spoiler alert, this is not going to be, I'm not going to end up saying you should or should not do anything. I'm just going to tell you right out. I'm not going to say you should or should not, because it's dependent on your situation. It's dependent on a lot of factors. I can't sit here and tell you that you should or should not dabble in the stock market. That's up to you. But what I'm going to do is to kind of frame the conversation with some information, some insights and opinions that will hopefully add to the information you have to help you make a better informed decision. So let's start with statistics on day trading. So these are, I'll put a link in the show notes here to the sources for all these statistics. There's a lot of research done on these, but I've kind of compiled some statistics from one source that kind of aggregates them together. And there's a few eye-opening statistics about the market here, or about day trading specifically, rather. First off, 80% of all day traders quit within the first 2 years. That's interesting. That's really telling that 80% of day traders, they just give up after a couple of years. They just don't stick with it. You could speculate on why, but I think it's fairly reasonable to assume that it's because they're not making money on it. They're not seeing success. Why else would you quit otherwise? So that's one interesting statistic. The average individual investor underperforms a market index by 1.5% per year, and active traders underperform by 6.5% annually. So anywhere from 1-ish to 6-ish% underperformance is the norm. So if you're, comparing with the S&P 500, for example, that's the biggest market index that we tend to go to. Most traders, most active day traders, underperform just the S&P by 1-ish to 6-ish%, which is significant. Next, traders with up to a 10-year negative track record continue to trade, suggesting that day traders even continue to trade when they receive negative signals regarding their ability. This is interesting, and I like pointing this out because it points to a flaw that we all have as humans. And that flaw is that we just tend to want to believe that the next time we do this thing, it's going to work out. We're going to turn a corner. That persistence will pay off. And persistence does pay off in many things in life. But in this case, traders up to 10 years that have up to a 10-year track record of negative success, they still stick with it. So there is something about the gambling aspect of playing in the stock market that really kind of addicts people to the game itself and addicts people to the process of trying to win. And so I think it's telling, and it's interesting to be aware of that, to know that so much of the time it's difficult for us to unplug our emotions from the process of what we're doing. It may be obvious to everyone that this is not working out for whatever reason, but as humans, we kind of hang on to that desire to keep looking for success around the next corner. And so it can be as dangerous as gambling to many people. So I think it's an interesting statistic to point out. Excuse me. Next, this is not to be judgmental. This is not judgy at all, but traders with a high IQ tend to hold more mutual funds and a larger number of stocks. Therefore, they're benefiting more from diversification. So again, not to be judgy, but it appears that people that have higher intelligences tend to favor more diversified investments like mutual funds. Next, profitable day traders make up a small proportion of all traders, 1.6% in the average year. That is a very tiny percentage of people that actually are profitable doing day trading. Next, actually, I actually put one here twice, so I'm done with my list. So those are some interesting statistics. I've seen different numbers. You can look up different sources. You can look up all this stuff, and it all pretty much confirms the same general theme, which is that most day traders do not succeed. They don't make money. I've seen anywhere from, in this particular list, 1.6 percent versus, some sources say, up to maybe 10% of day traders actually make some money. I've seen that range, 1 to 10% ish is the range of people that actually succeed doing day trading, making at least some money, or at least not losing money. So wherever in that, broad range is, it's still pretty minimal. It's still the odds are fairly stacked against you that you will actually make money doing active trading. Now, again, this is all based on day trading. This is assuming that your goal is to, play in the market, open up your Robinhood app, make trades, kind of be active, and kind of have fun that way. Let's talk about buy and hold. Let's talk about the other end of the spectrum, which is simply investing in individual stocks. So let's say you're not going to day trade, but you say, you know what, I want to choose stocks. I want to pick stocks, and I want to invest money in those stocks because I feel like I will get a higher return from individual stocks, because I'm not necessarily like diluting the returns across a big mutual fund. I'm kind of zeroing in on a stock. So let's talk about that a little bit. So when it comes to buy and hold, it's certainly less of a risk for a lot of people to do buy and hold than to do day trading. It's longer term. When you're holding on a stock for a longer term, you've got a longer time period to let the returns kind of result from that. So I consider it less risky. So when you're looking for stocks to buy and hold, you want to look for a few things. One thing is looking for trends. So a lot of people will look for a stock that is showing earnings that are continuing to increase. Companies that have earnings that are year over year growing consistently and reliably. That shows that the company is headed in a positive direction, that it is good at making money consistently. It's good at increasing and growing those earnings. That's a reasonable signal to tell you that this stock may be worth considering. And by the way, caveat, none of this is investment advice. None of this is specific. Please do not take it as specific advice. This is general education only. Next, you also want to maybe look at the company's strengths next to its similar companies in its peer group. So if you have a company in a certain industry and it's surrounded by competitors, does this particular company that you want to invest in, does it have a competitive advantage for some reason? Is there some reason this company has some edge over its competitors that can be easily identified, and therefore it might be more of a favorable outlook for that particular company? Again, we can't predict the future. We don't have a crystal ball, but that is a reasonable point of data to look at. Next, look at some ratios. Look at debt to equity. Does the company have a lot of debt? If you're looking at a particular stock, does the company have more than a third of its ratio in debt? Like, 0.3 is kind of the magic number you're looking at for most industries. If the debt to income ratio debt to equity ratio is more than 0.3, then it's a little bit lopsided toward debt. Also, price to earnings. Are the price to earnings high, or are they low? Are you looking for a value play? Are you trying to buy an undervalued stock, or are you trying to buy a growth stock that people think is going to increase in value because it grows? So look at those. Also, maybe you're not in it just for the money. Maybe you simply care about a company because you want to align with, their culture, their values, the leadership, the ESG factors. Maybe this company is in clean energy or has some particular alignment toward an area or value that's important to you. Maybe it's a personal alignment. Maybe you have a huge nostalgia toward Disney, and therefore you want to own Disney simply because you have an emotional attachment to it. I don't think that's invalid. I think that's valid, assuming it's a strong company. It's a company you have experience with. Maybe you go to Disney every year. I'm not endorsing Disney at all. I'm just saying as an example. Maybe you go to Disney every year, and you see the operations, inside out. You're impressed by how well Disney is run. You believe in the company. Yeah, that's not a terrible reason to invest in a stock. Sustainability and stability as well. Does the company show that their earnings and the stock price is fairly stable? Does it bounce around, or does it show a lot of consistency and stable growth over time? That is a reasonable data point to look at, to expect that there is some evidence that it may continue to have that same stability. It may not. You can't predict the future. There's no guarantee of future returns or future behavior, but all we have to go on is looking at the past. So if you feel like a company has a decent track record and all of the components in place to show that it's a stable, reliable company, then that could be a data point to look at as well. So that's kind of the buy and hold approach. So let's talk about how to decide what you want to do. Do you want to buy and hold? Do you want to day trade? Do you want to do some of both? Do you want to kind of see how it goes? Really, do you just want to kind of get in the market and feel like you're participating? So first thing I would look at is understand the spectrum of risks. Understand, the risk of very active day trading versus the risk of buying a few stocks and holding on to them for a long time. Day trading, fringe startup companies is very different than, buying a large Fortune 500 blue chip stock and holding on to it for 20 years. Those are two wildly different things. So understand the risks, understand where you see yourself in that spectrum of risks. Are you going to open up your Robinhood app and you're going to just day trade and kind of make money on the fly and be very active and sink a lot of time into it? Or are you going to buy stock XYZ of a big company that's been around for a while that is a staple of, our human existence and just hang on to it for a long time? That's very different. Also, understand the benefits of diversification. The reason that people like me, financial advisors and people in the industry love mutual funds so much is because it lowers the risk so significantly. So when you're investing in a single stock, you're putting all your eggs in one basket. You're saying, hey, I'm betting that this company is going to perform well, the stock price is going to go up, and all is going to go according to plan. You're assuming that. When you're buying into a mutual fund with hundreds of stocks, then you're saying, hey, I am spreading out the risk out among a lot of different companies. If one or two of them even go out of business, it's not going to take down my whole investment. It may lower the return a bit, but it's not going to necessarily lose everything. I'm going to still be in a decent position because the rest of the 99% of the other companies there are still performing positively. So that's why mutual funds are so important to consider and so popular in financial planning. And ETFs are this similar category is because of the diversification. You're diversifying across lots of different companies. So you're spreading out the risk among different companies. So understand the benefits. I shouldn't say the same. You can also diversify by investing in multiple stocks. And there are people that have a portfolio of hundreds of stocks individually. That may or may not fit your particular situation. I don't personally do it. I invest in mutual funds. But diversifying by holding a bunch of stocks can also achieve some of that diversification. Also, decide through the lens of your financial plan. I would say this is the most important. If your financial plan is set up in such a way that you have projections set up that are comfortable for you, your financial independence numbers are kind of at least ballparked, and you've got a path set in front of you, and you're budgeting well, and you have your emergency fund set up, your insurance is properly set up, and you're pretty much good to go, and you've got a solid plan in place, and you have an extra $500 a month to invest in the stock market, and you could stand to lose it. Yeah, maybe day trade. That's not a horrible thing. Have fun with it. Consider that entertainment money, or just kind of, play money that you are okay if you lose, but you might have some fun with it or might gain something. On the other hand, if you have a lot of debt, your emergency fund is not fully funded, you don't have a retirement plan in place, you're not saving in your Roth IRA, a lot of, boxes aren't checked yet in terms of where you want to be, then it's probably not an ideal time to experiment with extra money in the stock market, because there may not be extra money that is available for that. So it depends on your financial situation and your financial plan. So that's the most important thing. Regardless, I'm not a huge fan of putting a ton of money into single stocks, especially if you're going to be very active. So if you're going to put maybe 5, maybe 10% of your money into single stocks, you're going to have a broad basket of them. You're going to buy and hold for the most part. That's one thing that's pretty reasonable. If you're going to take 50% of your retirement savings and you're going to day trade with it, that scares me. That's concerning. So like many things, it's a spectrum. There's a spectrum of things, a spectrum of positions you can be in from high to low risk. So, and here's the thing. Remember this. The principles that lead to wealth and success are typically really boring. It's really boring to save $500 a month into your Roth IRA for 30 years. It's really boring. You don't see an immediate payoff. It just sounds boring to even say it out loud. It's just flat out boring. However, watching people make, thousands and millions of dollars on GameStop because of some weird stock market event. Sounds exciting. It sounds exciting to, be active and mess with stocks in your Robinhood app and watch what's happening on the news. And there's something happening out there, and this all sounds very exciting. So keep in mind that that's part of the lens that you might be looking at this through is, oh, there's something happening out there that sounds fun. But ask yourself, is it truly a sound principle that is going to lead to potential wealth? Again, investing $500 a month into your Roth IRA for 30 years is very boring, but assuming reasonable returns, you end up with $1 million if you do that. So again, think of that. FOMO, fear of missing out. That drives a lot of us. And that fun versus boring aspect of things can also drive a lot of our decisions. So I would encourage you to just think through all the information available to you. Think through your financial situation, your financial plan, where you feel you are on that risk spectrum, how much money you feel like you have to devote to potentially high risk activity. Can you stand to lose that money? Are you okay with it if you do? These are all the things I would think about. So again, I'm not going to answer the question for you. Should I play around in the stock market? That is for you to answer. But my goal was to have a conversation that causes some additional thought and insight and perspective around the question. So with that, I hope that has been helpful. And as always, I'm available for questions or just general conversation if you would like to chat. My website is elevationfinancial.com. You're welcome to always reach out. And I was telling someone this morning, I'm super low pressure. So plenty of people reach out and just have a quick conversation via that button on my homepage that says book a free money session. And there's even a box you can check. You can say, hey, do you want to hear more about working with me or not? And if you say, no, I just want my questions answered, cool. I won't even tell you what I do or how to work with me. I won't even try. I'll just answer your questions and I'll say, cool, good to go. Great. Glad I helped. No obligation. So it's really, truly a no strings attached free consultation. So feel free to take advantage of that if you like, because even if you and I don't work together, maybe you'll think of me when someone else needs help. So it's totally fine. Totally happy to help with that. Again, elevationfinancial.com. Feel free to reach out and have a great day. We'll see you next time. Thanks. All right. I see someone still sticking around here. So thanks for those who joined via Facebook Live today. If you have any comments or questions, pop them in the comments there in the next 5 to 10 seconds or so, as always. And I'll be happy to chat. Otherwise, thanks for being here. Always love seeing Facebook Live viewers. Makes my day to have some people join me as I ramble on with some of this stuff. So thanks so much. Have a great day. See you next time.